Hello friends, welcome to Letstute Accountancy. So in previous session we did question number 1 on dissolution of partnership firm. In that question we prepared ledger accounts, but there were no insolvent partner. Now in this question, that is question number 2, there are 3 partners and out of which there would be one insolvent partner. So we will solve a sum on the dissolution of partnership firm when there is one partner who is insolvent. Okay, so we'll start with the reading of the sum. Following is the balance sheet of Messrs. LMN, Partners Capital Account LMN, Partners Current Account LM, Creditors, Expenses Payable, Furniture, Goodwill, Stock, Debtors, Profit and Loss Account, so this is accumulated loss, and ends Current Account. So this is Partners Current Capital Account and Current Account both are given. So this is fixed capital method. Over here your capital accounts remains constant and all the adjustments are made in the current account. Also, N's current account has a debit balance. Mr. N declared insolvent. So over here out of 3 partners, one partner is declared insolvent and could pay only 25% of the balance due from him. Firm is dissolved and assets realized as follow: goodwill nil, furniture at book value, stock 19,000, debtors 17,000. A contingent liability against the firm for 6,000 is cleared. Creditors allowed a discount of 10%. The partners are sharing profits and losses in the ratio of their capital. The partnership deed provides that the deficiency in the capital of an insolvent partner is to be borne by other solvent partners in their fixed capital ratio. Give journal entries and ledger accounts to close the books of the firm. So now in this question we are required to prepare journal also and ledger accounts also, where one partner is insolvent and we are dissolving the firm. Also, when we prepare the ledger account, we will prepare realization account to realize your assets and pay off your liabilities. We will prepare partners capital account, but over here we will also prepare partners current account because 2 different accounts are given, capital and current. And we will prepare cash account for the payments and the receipts of the assets realized and everything. So we will also prepare cash account. So these are our ledger accounts: realization account, cash account, partners capital account for 3 partners, and partners current account for 3 partners. And if there are any working notes, and we will also require to prepare journal entries. So we'll prepare journal entries, date, particulars, LF, debit, credit. So we will do journal and ledger simultaneously. Now what is the first step when we dissolve a partnership firm? When you dissolve a partnership firm, the first step that we discussed in the previous question also is to dissolve or to close the balance sheet of the firm, existing balance sheet of the firm. So we will transfer assets and liabilities to realization account, partners capital and current account to their respective account. So first step is to close this balance sheet and then we'll start with the adjustment. So starting with the closing with the balance sheet, starting on the asset side. Furniture, goodwill, stock and debtors, these all 4 assets will be transferred to realization account. So we will pass the entry. Now in this question the date is not given. So in date column we can just put question mark and we can just number it. When we close the assets, what entry we pass? The assets account will be credited and it is transferred to realization account. So our entry would be realization account debit to close your assets, that is furniture account, to goodwill account, to stock account, to debtors account. So over here we will just close our all the assets account, and while closing the balance sheet values you will close it at book values. So furniture 4,000, goodwill 6,000, stock 18,000 and debtors 20,000. Now just total this up and transfer to realization, that is 4,000 plus 6,000 plus 18,000 plus 20,000. So that is 48,000. Don't forget to write the narration, being assets transferred to realization account. Okay, now post this into your ledger accounts also. So these would be debited to realization account. Okay, so this posting is done and we have closed our assets account. Next you have profit and loss account. Now this profit and loss account is transferred to partners capital account. Now before transferring, what we can just do, we will just write the partners capital and current account opening balances in your ledger. So partners capital account, now there would be no journal entry for transferring this capital account because partners capital account balance will appear in the respective capital account and current account balance will appear in respective current account. So we are not transferring from one account to another account. We are just writing the opening balances before the dissolution. So for the capital account we say as buy balance brought down, L is 16,000, for partner M 8,000, for partner N 6,000. So we are done with furniture, goodwill, stock, debtors and partners capital account. Next, partners current account. So in partners current account, buy balance brought down, for partner N, L is 8,000 and partner M is 4,000. So that is done. And for partner N, it is current account appearing on the asset side. So this is our debit balance since it appears on the asset side. So that will come on the debit side. To balance brought down 2,000. So that is done. Okay. No entry is passed for this because we are not transferring from one account to another account. Next, now we can transfer now P&L account between the partners. Now this is your accumulated loss. Any accumulated profits or losses are shared between the partners because that belongs to partners. So that would be shared between the partners in their profit sharing ratio. What is the profit sharing ratio? So that is given over here. The partners are sharing profits and losses in the ratio of their capital. So we can just prepare working note 1, profit sharing ratio, L is to M is to N. Now the ratio of their capital, so that is 16,000, 8,000, 6,000. So we can say 16 is to 8 is to 6, that is as good as if we divide by 2, 8 is to 4 is to 3. So this we can say as profit sharing ratio. So now our profit and loss account debit balance will be shared between the partners in this ratio, that is 8 is to 4 is to 3. Generally, if the current account is not given, we make all the adjustments in the capital account. But if the current account is given, then all the adjustments are made in current account. So first of all, pass the journal entry for the same. Second, the profit and loss account, this is your debit balance, it would be credited and transferred to partners current account. So L's current account debit, M's current account debit, N's current account debit to profit and loss account. Balance in profit and loss account is 12,000. Now that debit balance is credited over here. So we close our P&L account and transfer between the partners in the ratio 8 is to 4 is to 3. So the total is 8 plus 4 plus 3, that is 15. So divide this 12,000 divided by 15 into 8 equals 6,400, 4 equals 3,200 and 3 equals 2,400. Being profit and loss debit balance transferred to current account or partner's current account in ratio, in their profit sharing ratio, that is 8 is to 4 is to 3. So that is done. Now post this in your current account to profit and loss account 6,400, 3,200 and 2,400. So that is done. So we are done with this profit and loss account also. Next, this capital and current opening balances are given. Next is your creditors and expenses payable. That would also be transferred to your realization account. Your entry would be, now this liabilities have a credit balance. To close this liability, it would be debited. So we say creditors account debit, expenses payable account debit to, and it is transferred to realization account. All your assets and liabilities are transferred to your realization account. Creditors is 8,000 and expenses payable is 12,000. So total 20,000. So this is done, being sundry liabilities transferred to realization account. So now we are done with closing of the balance sheet. We have closed all the accounts of your balance sheet, existing balance sheet, and now we are left with only 4 accounts. That is realization account, cash account, partners capital account and partners current account. There is no opening balance of cash. So at the time of dissolution, if you see the balance sheet, there is no cash bank balance. Now starting with the adjustments. Mr. N declared insolvent and could pay only 25% of the balance due from him. That we will do at the end, because when we close our partner's capital account and when the time comes for the final settlement, when you realize your assets, you pay off your liabilities and remaining amount is paid to your partners, or if any amount due from partner, it is received from the partner. So when the time of final settlement comes, at that time this adjustment will be done. So this will keep aside. Firm is dissolved and assets realized as follows. So we'll start with this adjustment. Our goodwill could not realize anything. Furniture realized book value, that is 4,000 itself. Stock realized 19,000 and debtors realized 17,000. So we'll pass the entry for this first. When your assets are realized, when you realize your assets, that means you are receiving cash. So we'll say cash bank account or only cash account debit. 2. Will we write the name of these assets? No. You have already transferred these assets to one common account, which is your realization account. So when you have transferred all your assets to realization, now all the entries related to assets realization or liabilities payment will be done through only one account, which is your realization. Actually, all the further entries after closing of your balance sheet, you have only 4 accounts left. So all the entries will be done between those 4 accounts. Okay, so cash account debit to realization account, and we can just total this up. 4,000 plus 19,000 plus 17,000. So that comes to 40,000. Being assets realized. Okay, we will do the posting for the same. Okay, we have not done this transfer of liabilities to realization, so first of all we will do that entry by creditors account. What you can even do, first you write all the journal entries and then do the posting, or else you can do together, writing the entry and then posting, then writing the next adjustment entry and then posting. By expenses payable account, 12,000. Next, when you realize cash, now when you have transferred the asset, it is debited to realization account. So when you realize, it would be credited by cash account. Now over here, write the details, whatever you have realized. So in that case, we have realized furniture 4,000, stock 19,000, debtors 17,000. So that comes to 40,000. Second effect of which goes to cash account, to realization account, assets realized 40,000. So this is done. Goodwill, furniture, stock, debtors. A contingent liability against the firm for 6,000 is cleared. Now what is this contingent liability? Contingent liability is a liability which may or may not arise in your future. So some act or something is done in the current period due to which you may or may not incur a liability in future. So that is why it is called as contingent. If there is a contingent liability, it is not shown in your balance sheet because it is not yet incurred, it is not yet arised. It may or may not arise in the future. So right now, if you see your balance sheet, you don't have this contingent liability, but at the time of dissolution, this liability for 6,000 is cleared. What do you mean by cleared? It is paid off. So at the time of dissolution, probably this contingent liability would have arisen, and since it is arisen, the firm would have paid this 6,000 for this contingent liability. So we'll pass the entry for the same. Fifth, now when you pay a contingent liability, you don't have that account name of contingent liability, but you are making a payment. So it is as good as a loss for the company because we have not recorded any liability, and at the time of dissolution we have to pay extra liability. This 6,000 was not appear to be payable, but now it is paid off. So that is a loss for the company, for the firm. So that is why that will be also recorded in your realization account. So we'll pass the entry as realization account debit to cash account 6,000 being contingent liability cleared. Okay, so we'll post this in your ledger. It will be debited to realization account because that is a loss for the firm, to cash account for contingent liability 6,000 and credit to cash account by realization account 6,000. Next, creditors allowed a discount of 10%. So when we are making the payment to creditors, there is a discount of 10% on this. The partners are sharing profits and losses in the ratio of capital, and they are talking about the deficiency. Now what about this expenses payable? Contingent liability we paid off, creditors are to be paid off at a discount of 10%. But what about this expenses payable? Would the firm have paid this expenses payable or not? Definitely yes, the firm will pay this expenses payable. So since nothing is specified about the how much amount is paid for this expenses payable, we would assume that the entire 12,000 would be paid off. So if they don't specify in your question about the external liability being paid off, always assume that whatever is the book value, that is the balance sheet value of the liability is there, that entire amount is paid off, unless and otherwise any other adjustment is given in your question. So we'll pay off our creditors and expenses. So that would be our entry number 6. So this is your contingent liability paid off. Now starting with the next entry. Since we are paying off our liabilities, so cash account would be credited. And again, when your liabilities are transferred to realization, it is credited. So now when you pay off, your realization account would be debited. So we'll say realization account debit to creditors account to expenses payable account. Creditors are settled at 10% discount. So 8,000 minus 10%. So 8,000 minus 10% is 800. So this must have been paid at 7,200. Okay, this would be credited 7,200. And expenses payable is 12,000. So total 19,200 being liabilities paid off. Post it to realization account to cash account, creditors and expenses payable. Creditors 7,200, expenses payable is your 12,000, total 19,200. Credit this to your cash account by realization account. This is for liabilities paid 19,200. So this adjustment is done. Contingent liability 6,000 cleared, creditors allowed 10% discount. Partner share profits or losses in the ratio of capital that we already found out in our working note, profit sharing ratio. Now the partnership deed, now this is important or a new thing for this question. The partnership deed provides that deficiency in capital of one of an insolvent partner. Over here, Mr. N is declared insolvent. So if there is any deficiency in the account of Mr. N, it is to be borne by other solvent partners in their fixed capital ratio. This we will do when we do the final settlement. So now first of all, we have done all the adjustment related to realization. We have transferred assets, transfer liability, realize assets, paid off the liabilities. There is no realization expenses or dissolution expenses. So first step is you close this your realization account and find out profit or loss on realization. We'll start with the debit side. 4,000 plus 6,000 plus 18 plus 20 plus 6,000 plus 19,200. So this side comes to 73,200 minus 8,000 minus 12,000 minus 40,000. So debit side is more 73,200 and your balancing figure is 13,200. Now this loss will be shared between the partners. Now since we have current account, so it would be transferred to partners current account. We have partners LMN by partners current account in the ratio, in the profit sharing ratio, that is 8:4:3. 4:3. So 13,200. Now total of this 843 is 15. Divided by 15 into 8 equals 7040, 4 equals 3520 and 3 equal 2640. This we can say as realization. Is your profit or loss? Since your debit side is more, this is your realization loss. Transfer it to partner's current account. So here it is credited, so in partner's current would be debited to realization account for loss. 7040, 3520 and 2640. Pass this in your journal. 7th, else current account debit, ends current account debit and ends current account debit to realization account. 13200, 7040, 3520, 2640. Don't forget to write narration being realization loss transferred. Now after this we are left with 3 accounts: cash, current and capital. So first of all, we will transfer the balance of current account to partner's capital account. So we'll close this current account. Over here it is debit balance 6400 plus 7040, that is 13440 minus 8000, that comes to 5440. By partner's capital account. Next, for partner M, 3200 plus 3520, that is 6720. 6720 minus 4000 is 2720. And last, for partner N, 2000 plus 2640 plus 2400, so that is 7040. So this comes to 7040. So for all the 3 partners, we have a debit balance in our current account that is to be transferred to partner's capital account. To partner's current account, 5440, 2720 and 7040. Now when we close finally capital account, whatever balance is left in your capital, if it is a credit balance, that means the amount is payable to partners, that would be paid from your cash account. But if you see now in partner N, so they have given us in question, partner N is declared insolvent and could pay only 25% of the balance due. So first of all, we'll check whatever the amount is balance due from partner N. So we'll say working note 2, this is about the deficiency. Balance due from N. How much is the balance due? 7040 minus 6000, that is 1040 is due from N. Why it is due? Because over here your debit balance is more than your credit balance. So it is the debit balance in partner N account. So we need to receive 1040 from partner N. In case of L and M, if you see in both the cases, your credit balance is more than your debit. So that is amount payable to partners. But if it is your debit balance, that amount is receivable from the partner. But he could pay only 25% of the balance due. So now we can say amount receivable from N is 1040, out of which 25% is received. So that comes to 1040 into 25%. So partner N could pay only 260 and balance left, or we can say balance is deficiency. 1040 was receivable, out of which 260 received. So minus 1040. So that is 780. Now this balance deficiency. So what partnership deed provides? The partnership deed provides that the deficiency in the capital of an insolvent partner, that is partner N, it is to be borne by other solvent partners. So it is to be borne by other solvent partners, that is L and M, in their fixed capital ratio. So this is to be borne by L and M in their fixed capital ratio, that is 16,000 is to 8,000. So we can say this is 2:1, 8:4 or 2:1. So this 780 is to be borne by solvent partners. These are your solvent partners, that is L and M, and it is to be borne in the fixed capital ratio, which is 2:1. 16,000 is to 8,000. So now when we divide 780 divided by 3, that is 260 from M, and into 2, that is 520 from L. It would be received. L will bear the deficiency of 520 and deficiency to be borne by M is 260. So the balance amount which cannot be received from insolvent partner, it is to be borne by solvent partners. So we'll pass the journal entries for the same. First of all, Mr. N is paying 260. So we'll receive the amount of 260, 25% of the amount due. So cash account debit to N's capital account 260, 260. We can give the reference of working note as per working note 2 and write the narration being 25% of the balance due received. So this amount is received from Mr. N and now we will record this in our ledger account. So if this would be debited to cash account and it would be credited to N's capital account. So cash account is debited to N's capital account 260 and it is credited to N's capital account by cash account 260. Now remaining amount of deficiency that we calculated over here of 780. This 780 of deficiency, it is to be borne by the solvent partners, that is L and M, in the ratio 2:1 that we calculated. So how it would be borne by this solvent partners? First of all, we need to close N's capital account. So N has a debit balance. You need to close this, so it would be credited. And the deficiency which is to be borne by the partners, it would be debited to partners capital account because it is as good as loss which is to be borne by the solvent partners. This loss or this deficiency of insolvent which is to be borne by solvent partners. So our entry would be L's capital account debit, M's capital account debit to N's capital account. So now the deficiency is 780 and for borne by L is 520 and M is 260, being deficiency of partner N borne by L and M. Okay, we can also give the reference for working note 2. So whenever you prepare working note, it is always better that you give the reference. Now do the posting for the same. It would be credited to N's capital account. So by L's capital account 520 by M's capital account 260 and it would be debited to L and M capital account. So to N's capital account in L 520 and 260. Okay, so with this your N's capital account should have been closed. So we'll just check this. This is 7040 and check on your credit side 6000 plus 260 which is your cash brought plus 520 plus 260. So that also comes to 7040. So the capital account of partner N who is declared insolvent is closed. So now this was a new part in this question where in the beginning the realization account was prepared as usual, but when the deficiency come or one partner is declared insolvent, what we need to do? We need to find out the final amount which is brought by insolvent partner. It can be possible that the insolvent partner does not bring any amount. So this would be 0 and the entire deficiency will be borne by the solvent partners. So solvent partners are bearing the deficiency in the fixed capital ratio, that is their ratio of 2:1. Then we pass the entry for cash brought by insolvent partner, the full and final cash or full and final dividend which is received, and balance deficiency which is shared between the solvent partners, and we did the posting over here. So these 3 entries are quite important when a partner is declared insolvent. Now after this, the remaining partners will be paid off through cash because they are solvent. If required, they will bring cash. If not, if they have a credit balance, then the cash would be paid off. So we'll just check in partner L, credit side is more. This is 16,000. Now out of this 16,000, find the balancing figure. 16,000 minus 5440 minus 520. So that comes to 10,040, 10,040. This would be paid through cash. Whenever there is a balancing figure, put a circle. And for M also credit balance is more. 8,000 minus 2720 minus 260. So that comes to 5020. This is also paid through cash. And second, if I goes to cash account by L's capital account by M's capital account, 10,040 and 520. And finally, all your payments are done to the partners, the liability holders, and everything is done. And now your cash account should get tally, should get closed, because whatever the amount remaining must be paid off. So this is 40,000 and 260. So we'll just check this. 6,000 plus 19,200 plus 10,040 plus 5. So this is 5020, not 520. 5,020. So plus 5020. So that is 40,260. And our bank cash account is closed. So over here we dissolve the firm and we have closed the books of the firm. So people, this question is very simple. Again, first of all, close the balance sheet. If we just see the journal entries, when you make the payment, just need the last final entry of this payment made to the partners. Don't forget this. L's capital account debit, M's capital account debit to cash account. This is full and final settlement. 10,040, 5,020, 5020, and this is 15,060 being final payment made to partners. So guys, what we did first of all, we transferred the asset. So we closed our balance sheet, transfer assets to realization. Then we transfer profit and loss, that is your accumulated loss debit balance, to partners capital account. Over here there was a current account also maintained, so it is transferred to partners current account. Capital and current opening balance goes to respective account. Creditors and expenses payable goes to realization. Then we realize assets, we paid off contingent liability. We also paid our external liabilities, that is creditors, expenses payable. After that, whatever the realization profit or loss comes, transferred to current account. If there is no current account, transferred to capital account. Then since one partner is insolvent, so from the 8th entry, your insolvency part starts. When one partner becomes insolvent, we found out how much amount is due and how much is paying. So that amount is received through cash. Balance deficiency is borne by the solvent partners. And full and final settlement, whatever the final settlement is made to the partners, to the remaining solvent partners, is paid through cash. And if we see our ledger accounts, our realization profit loss transferred to partners current account balance is transferred to partners capital, deficiency entry are done, and then whatever final balance of capital is transferred to cash. And finally your cash account tallies. That means our books of accounts are closed. Whatever cash was there is paid to your liabilities, and finally it is paid to the partners whom the cash amount was payable, who has a credit balance. So what we did, first of all, we transferred all our assets. So while closing the balance sheet, we transferred all assets to realization account. Then profit and loss debit balance is transferred to partners current, since there was a current account. Otherwise it would have been transferred to partners capital account. Next, the partners capital and current account opening balance are written in the respective account, debit or credit balances. Creditors and expenses are transferred to realization account. After that, we realized our all the assets. Then we paid off contingent liability. After that, we paid off liabilities of creditors and expenses payable. They have not specified anything about this expenses payable, but it is implied that it has been paid off. Then whatever is the realization profit loss comes, that is transferred to partners current account. So over here it was realization loss which was transferred to partners current account, and whatever is the partners current account balance is there, that is to be transferred to partners capital. So friends, we have forgotten to write this entry over here, so we are just marking this entry here. When we transfer current account balance to capital account, since one account balance is transferred to another account, make sure you pass the entry for the same. So our entry would be, we are transferring to partners capital account, so we'll say L's capital account debit, M's capital account debit, N's capital account debit to L's current account. Now we can even pass separate entry for each of the partner, or you can pass combined entry for all the three partners. M's current account to N's current account, and these are the balancing figures: 5440, 2720, 7040, 5440, that is transfer to capital, 2720, 7040, being current account balance transferred to capital account. So these balances are transferred to capital account. Make sure you don't forget this entry. After that, the insolvent partner brought only 25% of the amount due. Mr. N has a debit balance, so he brought 25% of the amount due, that is 260 rupees, 260. After that, whatever the deficiency of Mr. N was there, it is borne by solvent partners, so that is L&M in capital ratio. And finally, whatever the balance of L&M comes, it is paid off through your cash account, and our cash account tallies. So that is, our cash account is paid, all the cash is paid off, and our books of accounts are closed on the dissolution of partnership firm. So friends, this is very simple to solve. Just go systematically and a step by step, then this would become very simple to solve. You can easily solve this question in 15 to 20 minutes. So if you have any doubt or any queries regarding this question or dissolution of firm, you can just post in the comment section below. Thank you.